Rates this week looked like that they were poised potentially to get a little bit better than they already were. The report in question is from the Institute of Supply Management. It has marginally helped out interest rates. But good news for the economy here at the end of the week, pushed stocks up with the S&P reaching an all-time high. So where are rates right now? Where are they likely to head next week? What's going to cause them to go up or down? And when, why, how is the Federal Reserve going to change things in a way that impacts interest rates for the worse? Watch the whole video for these answers and so much more. All right, where rates are at now is very much in flux. And the fluctuation between rates early in the week versus the end of the week didn't really show up in their average figures. So their numbers this week actually showed the average 30-year fixed rate drop just a hair from last week. It was at 2.8%. And then this week on Thursday, Freddie Mac says it's 2.77%. It seems to me that what we're going through right now is a pattern of kind of bouncing around a relatively narrow range. As different economic reports come out, that's going to push and pull on stock prices. As the stock market does better, as it did today, that's going to cause rates to get a little bit worse. But fundamentally, I don't see any of the movement that's going to be happening outside of the Federal Reserve changing things in a way that's going to be, for lack of a better way to say it, big. If you add up the 7 chairs sitting at this conference table and you put Chairman Powell here at the head, what you've got are these 7 governors that make up the Federal Reserve. These are the most important people as it relates to what mortgage interest rates are going to do over the coming months. Now, since COVID started, what the Fed has been doing could be described as an incredibly delicate balancing act. You've got economic stimulus on the one hand and inflation on the other. There are essentially 2 things the Federal Reserve said that they were going to be looking at as it relates to whether or not, or rather when, they're going to begin tapering their purchasing of these mortgage-backed securities. This purchasing activity is essentially what brought rates down low to begin with. The 2 things that they care about are, number 1, the economy, specifically employment. As far as employment goes, what the Fed has said is that they're looking for substantial further progress toward a fuller employment economy. As usual, the Fed never actually goes through and defines the key metrics in advance with any specificity. So at the same time, they've also said that they have to keep inflation in mind. The ultra-low interest rate environment that the Fed policy has created is supposed to operate kind of like an economic Swiss Army knife. On one hand, it's a tool to allow people to afford their mortgage payments more easily. For the numerous Americans that ended up with their mortgages in forbearance, there were more that benefited by reducing their payments, locking in these crazy, insane low interest rates, many times for 30 years. This Fed policy Swiss Army knife has also cut barriers in terms of access to capital for business owners. Now, I'm not going to make a value judgment or a political judgment as to the sensibility of these policies, in my opinion. But what I will say, and the Fed's own statements indicates that they agree, is that this economic Swiss Army knife is a true double-edged sword. The more cheap money that you put into the system to make it easier for business owners to stay afloat, to make it easier for people to stay comfortably in their homes with lower payments, the more prices are going to rise, and the more they have already risen. Housing prices alone are up something like, depending on the source you look at, 18% nationwide over the last 12 months. I think we've all experienced it, even just day to day in our lives, just by observing what we're paying for products, goods, services, etc. Now, the Fed knows that this is a delicate balancing act. They know that there's only so much stimulation you can do before that stimulation causes totally undesirable consequences that are completely counter to the motives underlying these policies. The report that they're going to be looking at next week on Wednesday is a consumer price index. Now, it does drive me completely nuts when people refer to the CPI as inflation. Just because it is a measure of inflation does not mean that those 2 things are one and the same. I won't go into the numerous problems with the CPI in this video, but suffice to say it is a government statistic used to support government and Fed policies. On paper, it's supposed to represent kind of a static basket of goods and how that basket of goods changes over time in price. The main problem with this is that there's a lot of interesting math that goes on in determining the CPI. what gets included in the basket and how much weight those items are given in the calculation can vary from time to time. I don't think it's particularly controversial or even debatable to point out that, at least in theory, the CPI could be manipulated. But regardless of whatever weaknesses I might find with the CPI as a valid metric of inflation, the reality is that our markets are driven by information, regardless of the quality or accuracy of that information. And the Federal Reserve is absolutely going to be making policy, at least in part, on the basis of the CPI. If the CPI comes in worse than expected, what you can expect is that this is going to apply pressure on the Federal Reserve to begin tapering its bond buying program sooner. If the CPI numbers are better than expected, then perhaps the tapering won't begin until a little bit further down the line. People are making projections that the Fed could announce as soon as September at their big meeting that they may begin tapering this bond purchase program at some defined point in time in the future. I've seen estimates as early as October for the tapering. I've seen November come up a lot. I think that's kind of the middle of the road answer. Regardless of when the tapering begins, it's important to focus on the announcement of ending the tapering itself. Because as soon as that happens, the market is going to react simply because they know it's going to happen and when. And I just don't see a scenario here, regardless of when the tapering is going to start, that leads to better interest rates. I think the only real question here is how much will the interest rates go up and when? Finally, my recommendation going into next week for my low risk averse people to moderate risk folks, this is going to be a strong lock recommendation. Especially with the strong job numbers, there's really nothing on the economic calendar over the next couple weeks that I think has the potential to seriously help us on the rates. At the same time, if there's more good news about the economy, more good news about employment, that is going to have a tendency to maybe start ticking this rate up slightly as that good news about the economy trickles in. Even for my risk takers, the gamblers, I think at this point in time, with all due respect, anybody that's going to take a floating stance right now, I just don't see the upside potential that would lead me to delay a lock decision. One exception to this would be if you happen to be in that group of people that refinanced maybe last year, not at the absolute lowest point. And in order for it to even make sense at all to refinance, you need to see another 1/8 or a 1/4 point drop. By all means, hang on. I recommend getting in touch with a loan officer, hopefully me, but it doesn't have to be me. Get in touch with somebody that can actually proactively keep you posted as far as rate movements and when your target rate is reached. I guess I should say if your target rate is reached. Regardless of what mortgage rates do now or in the future, I would love to be your mortgage guy. Give me a call, shoot me a text. We can talk through your scenario. I'll give you some really high quality technical information about your options. Thank you so much for watching.